All right, Manish Gunwani joins us. Manish, fantastic to have you back on UT now. Thank you for joining us. You've just come back from a global tour, largely personal in nature. So before we talk about markets, let's talk about what your observations are. Has the world normalized?
I think clearly, Nikunj, we seem to be getting into the second phase of the bull market. And the playbook typically for that is you will get rising rates, you will get good growth, but so EPS growth should be fine, but price to earning multiples will start going down, to my mind, because you had an extraordinary stimulus last year, which pushed up liquidity, which pushed up price to earning multiples. Uh, Good part is I think India is probably a laggard in the global cycle in the sense that because of the second wave, we started recovering later. So India, I think, has more legs to go. So I'd be more positive on the Indian cycle rather than the global cycle. The developed markets saw higher stimulus, and B, on an 8-10 year basis, also US had been doing well. So I would be a bit more cautious in the global cycle. I would think that the Fed and maybe other developed market central banks are behind the curve. I think, um, and obviously, it's not something that they should be blamed for. I think none of us really saw the inflation being as sticky as it is because while with growth you did expect a pickup in inflation, but the fact that China has pulled out of a lot of manufacturing sectors, the supply chain bottlenecks. Now the risk to my mind is that what is being seen as transitory inflation. And if you remember, India went through this in 2011 to 13 that initially it started with for India, but basically what is seemingly fine. If it feeds into inflation expectations and inflation, which is more clear, then you could see a fairly steep rise in global interest rate at some point. Now, whether it'll be immediate or for India, again, it took to that out. So I think a lot depends on the dynamics of growth, but also how the central banks react. To my mind, if U.S. bond yields were to go up, even if there is a bit of correcting, that'll be healthy for the market in the medium to long term because um, clearly making money also can't be too easy in the market. So I think that we are in a very interesting phase. As I said, the good part is I think the outlook on an Indian business cycle seems better. But yeah, it clearly is going to be a phase where I think price to earning multiples will compress.
So you are saying that now stocks like Asian Paints, IRCTC, Jubilant Foodworks, Bajaj Finance, HUL, Nestle, I mean, I'm not getting into specifics, I'm just referring to them for the benefit of our viewers. They are unlikely to give market beating returns.
I would broadly agree with that. Obviously, maybe more cyclical stocks can still work to my mind because I also think that from a growth perspective, this is probably India's best moment in the last 10 years. Because very simply put, GDP has four components: private consumption, private investment, government spending, and trade. I think all four are well, partially because of low bases. So private consumption has a low base because of COVID. Private investment has a low base of 8 to 9 of low capex cycle. Trade, if global exports were flat for 2010 to 2020 before the jump which happened over the last 3 4 months. So I do think that the technical side has a good potential to work. But yeah, if there is not too much of operating and financial leverage in a stock, and if returns have been made by price turning expansion over the last 5 years, I would be cautious.
Fair point. Manish, now if there is such a large inflationary pressure which is kicking in, somebody is making money, and those are metal companies, resource companies, producers. So should one stay with that rate only, assuming that cost pressure is here? Because it's like a mathematical equation: x equal to y. So somebody at the end of the day will enjoy an advantage. Right now, the resource company, the producer companies, the mining companies, the metal companies, they are making money, and that is what markets are also recognizing. But is that trade here to stay?
I think the risk reward is better in that trade versus very stable companies. Again, I think it's a fairly standard thing towards the second half of a bull market that um, the more operating and financial leverage stocks work, um, the only risk being that at some point the cycle will break down. I don't see while obviously something like corona happens, no one can predict, but the good part, as I said, I think India, between growth and manageability, there is a good balance. So I would say that I would back Indian cyclicals with the operating and financial leverage today, more than global cyclicals or defensives.
What about the other end, Manish, which is that look, these kind of rates, these kind of elevated levels for metal, for commodities are unlikely to sustain. China is slowing down, the base effect would kick in. So, how about buying autos? How about buying commodity consumers rather than producers? Because producers have done well, but markets are
Yeah,
about investing future, not about analyzing past. The past resource companies have benefited.
true. So I would balance it between slightly upstream companies only because not because maybe these prices will hold, more because if you see the estimates on the street or whatever the market is expecting, it probably is expecting a very, very sharp fall in these prices, which may happen. So maybe aluminium will still fall, steel price will correct. I think very few people actually believe these prices will hold, right? The question is what is built into earnings versus what are the what is how does it play out in the prices may correct 15%, but probably what is being built in is 2000, 2200 versus 2500. 3000 is probably outlandish to a certain extent. So the this part, I think that part, that is one kind of trade. The other is, you're correct that probably need to look at commodity companies. But my only point there is that that kind of company has benefited massive price to earning expansion, which we've seen probably staples or something like that. Um, then even if commodity prices stabilize or correct, given that interest rates may go up, I don't think you will make too much money.
Good morning, Manish. So you're saying even if interest rates go up, you will not make too much of money. You made a case of the cyclicals. You like financials, as very apparent as well from when we look at the holdings. I want to just return to a recent interview of yours and just ask you if you still hold the same view, because a lot has changed since then, whether it's the energy crisis, the global supply disruptions as well. You had said that India is likely to close, Indian equities are likely to go home at the end of this year with a 25% type of return, which which is enviable of sorts. Do you still hold that view?
So we usually don't talk about return expectations, but I can only say that, let's say from a 2 year, 3 year perspective, I think earnings growth will be very robust, but market returns likely to be less than earnings growth. Now, how much of earning growth, obviously, in the market is expecting high teens to low 20s kind of earning growth. As I said, I do expect that. See, at this point, US printing 5.3% inflation, right? And your 10-year yield is 1.6. Now, I think the safe trade is to say that US bond yields need to go up. Now, we've this data is obviously not something which is only for 1 month. I mean, US CPI has been, let's say, 3-4% for quite a few months. So initially the thought that this is very transitory obviously has not played out. Even US wage growth in the employment report, the per hour wage growth is about 4.5%. So what I'm saying is that clearly between the fact that China has withdrawn from certain manufacturing segments, the fact that supply chain, whatever, there are inflation pressures which seem to have exceeded um, what everyone thought maybe 6 months. Now, the way this can play out is a couple of ways. That one is obviously, I think the base case for me is that there needs to be a kind of jump in interest rates, right, to get real rates to rational levels. The other way it could play out is there's a massive slowdown in growth. But given that, as I said, a lot of the world is still to open up, including India, Brazil, maybe Europe. Um, and you the real-time data on things like Korea exports and all, you can see that growth as of now is not an issue in spite of some Delta variants kind of narrative somewhere. But in general, global growth is not so much of a concern. Domestic growth, from whatever you can touch and feel, obviously still very strong. There's good pent-up demand on travel, hotels, airlines. So, given that growth, to my mind, is unlikely to disappoint, then I think the path of least resistance for interest rates globally are to come up. Which is why I'm saying that when you look at returns, we've obviously seen globally equities price to earning multiples have expanded, which a lot of it is because of lower discounting rate or lower interest rate. I think some part of it has to be given back. Um, but yeah, the good part is the earning cycle outlook continues to be robust.
Yes, that's of course the most important thing, right? And as everybody's horizon changes to 2022, Manish, what I'd like to ask you also is, and if I just look at the portfolio and the holdings, you folks like financials a lot. You like industrials, materials. IT and consumer related stocks are also there, but lower. Would you now look at auto more favorably? The reason I ask this is because a lot of the fund managers we've been speaking to lately have started adding auto to their list of likes.
Yeah, I think, look, between domestic cyclicals, you typically have financial, autos, cement, retail, etc. Now, there are nuances to them. Autos are a classical Indian cyclical, but only thing is we clearly have this issue of technology disruption in that sector. Maybe more on the two-wheeler and four-wheeler side. So a lot of our exposure, for example, is more towards commercial vehicles, which are more cyclical. But yeah, I mean, even on two-wheeler and four-wheeler side, obviously, if you get a strong cycle, stocks will still. So I think you have a fair amount of variety if you want to play the Indian cycle, and I can understand being bullish on autos. Let me put it that way. But whether it's my favorite among 4 or 5 segments, maybe they're not the top because the price to earning multiples of, let's say, a four-wheeler OEM is a bit tricky to predict. A lot of it depends on how the policy rollout of EVs happen, how the charging infrastructure rollout happens. But clearly, there's some very large groups pushing for all that quite strongly. But at the same time, as I said, if there is a sudden pickup in demand over next 2 years, the stocks may still work. So yeah, it's not really my highest conviction way to play domestic cycle, but whether it will be part of the domestic cycle uptrend if it plays out, yes.
Right. Manish, always good having you on the show. Thanks for taking the time out and speaking with us.
Thank you.
Let's move on.